Hello everyone. The purpose of this video is to illustrate the concept of IAS 2, more specifically how we value inventories. And I've recently had a class test and I saw that quite a lot of students got confused with that question. So let's look at what IAS 2 is really about. Well, IAS 2 states that inventory should be valued at the lower of cost and net realizable value. Now, the reason we want to value our inventory at the lower of cost or net realizable value is simply because in accounting, there is a concept known as prudence concept. And the reason we want to keep our inventory value low is simply because we don't want to overestimate profits. Because imagine if we do, that will be bad for the company, that will be bad for the shareholders, and so on and so forth. So, how do we go about? So, let's look at a question. And this question caused a little bit of confusion. We're told Stoker's inventory, as at 30th of November 2019, was valued at £1,200,250. All inventory lines were recorded at original cost. So far, there's no issue whatsoever. Then we're told there are obsolete items included within inventory with no scrap value. The original cost of these items was 23,400. Now, what does that mean? Obsolete means, well, they can be put to no use. It means that if we're selling them, well, we won't get anything with them. So the question is, should we include that as part of inventory? The answer is, well, no, we should not, because think about it, you are not able to sell them. So surely we should exclude them from inventory. And we will look at that later. We're also told the following is an extract from one of the inventory lines. It's not the complete list of inventory. We're told, well, let's look at the first one. Small vase, we have 350 units, cost 119, net realizable value 225. Now remember what IAS 2 states. Inventory should be valued at the lower of cost. So clearly cost or net realizable value. So clearly we don't have an issue with this one. Cost is 119. And remember we told inventories valued at cost. So this one cost is lower, so no problem whatsoever. What about this one? Again, cost is lower. Cost is 119, net realizable value 225, no problem whatsoever. But what about this one here? And hence the reason why I have highlighted that in yellow. The cost is 119, but net realizable value is 75. Now think about it. We are carrying an item of stock, and when we're going to sell it, we're only going to get 75. So aren't we overestimating the value of inventory here? So we need to bring it down to that value of 75. Let's look at how we work this out. Now, first of all, what is the original value of the stock level? So remember we have 945 units and this is valued at 119, 119. So right now the cost is this 112,455. But hang on, we need to bring this down to its net realizable value. So we need all of the 945 units to be brought down to 70,875. So the difference in these two, remember we need to bring it down to that value. So we need to bring it down by how much? By the difference between this value and this value. We need to bring it down by 41,580. And we also told calculate the value of inventory at 30th November 2019. No other inventory lines require adjustment. So remember our original inventory value is right here, 1,200,250. We need to take away, remember the obsolete stock, 23,400. Also, we need to bring it down by this value here. So The final value comes to 1,135,275 £70, sorry, and that will be your final inventory value.